Imagine building a whole retirement portfolio shrank down to one decision. You don't pick stocks. You don't choose how much to hold in bonds. You don't rebalance every year. You just answer one question. Roughly what year will you retire? Then you buy one fund and walk away. That's a target date fund, the closest thing investing has ever built to a set it and forget it button. You pick the year, say target 2055, and behind that one ticker, the fund spreads your money across thousands of stocks and bonds, then slowly shifts you from aggressive to safe as the date nears. That idea is so powerful that roughly $4.8 trillion now sits inside these funds, and they're the default in the vast majority of workplace plans. Your own 401k is probably in one right now. But one fund is a box, and that box hides two things that quietly decide how much you end up with: the fee and the glide path. Today we're opening the box. When you buy one of these funds, what are you actually buying? A target date fund is a fund of funds. That sounds technical, so picture a capsule. You buy one ticker, one line in your account, and inside are several other funds bundled together. Typically 4 index funds. Total U.S. stock, total international stock, total U.S. bond, and international bond. Think about what that means. The U.S. stock fund alone holds essentially every public company in the country. Add the international fund and you own companies all over the world. The bond funds lend your money across thousands of borrowers. So one click, one fund, and you instantly own a slice of thousands of stocks and bonds across the globe. That's the magic of the first idea. Instant, broad diversification from a single decision. You're not building a portfolio piece by piece, agonizing over how much goes where. The fund already did it. You just chose the destination, the year on the label. One honest note. The exact funds and weights vary by company. Some use more building blocks, some fewer. But the core idea holds. So it's a bundle of index funds. But here's what makes a target date fund truly different from buying those funds yourself. It changes over time, automatically. That path has a name, the glide path. Picture a plane coming in to land. Early on, it's cruising high, taking on risk for the reward of growth. As the runway, your retirement date, gets closer, it steadily descends to something safer. That descent is your shift from stocks to bonds. Let's use Vanguard's published path so the numbers are real. When you're young, decades from retiring, the fund holds about 90% stocks and 10% bonds, almost all growth, because you have time to ride out the swings. It stays at that 90-10 mix until you're roughly 25 years from your target year. Then the descent begins. The fund steadily trims stocks and adds bonds, year after year. By the time you reach your target year, you're at about 50% stocks and 50% bonds. And it doesn't stop there. For about 7 more years, it keeps lowering risk until it settles around 30% stocks and 70% bonds for the rest of your retirement. Sit with that. Over your investing life, this fund took you from 90% stocks down to 30 and never once asked you to lift a finger. Risk auto-decreases as the date nears. That's the glide path, the engine of the whole thing. One caveat I'll return to. Those numbers are Vanguard's. Other companies design their own paths, and they can look quite different. Now, why does that automation matter so much? Because it's not just convenient, it quietly protects you from yourself. Picture the do-it-yourself investor doing this manually. Every year they have to figure out what's grown too big, sell winners, and buy bonds to stay on track. As they age, they have to deliberately get more conservative. And when the market crashes, they have to fight the screaming urge to panic sell at the worst possible moment. Every one of those jobs is a chance to slip up or let emotion make the call. The target date fund holder does none of it. The fund continuously sells what's grown and buys what's lagged to keep the target mix and walks down the glide path on schedule, all automatically, inside one ticker, with no extra trading cost passed to you for those internal trades. That's the real prize, and it's behavioral. The fund removes a long list of decisions you might get wrong. Fewer chances to mistime the market, fewer moments where fear or greed grabs the wheel. The discipline is built into the product. This is exactly why these funds became the default in workplace plans. In industry language, a target date fund is the typical qualified default investment, where your money lands automatically if you don't choose anything. About 86% of 401k plans use one as that default, and roughly 91% offer one at all. One honest limit. This behavioral edge is about removing chances to make mistakes. Not a promise of higher returns. It helps you stay invested and on plan. It doesn't guarantee you'll beat anything. So far, this sounds almost too good. Now let's look at the two things that can quietly cost you. Here's the first. The year on the label is not a standard. You'd assume two funds, both labeled 25/5, must hold roughly the same thing. Same year, right? Wrong. Each company designs its own glide path, so two funds with the exact same name can carry wildly different amounts of risk. Here's how big the gap gets. Take funds about 5 years from retirement. Across the industry, the stock they hold has ranged from roughly 25% on the most conservative end, up to about 55% on the most aggressive. A 30 percentage point spread between funds that wear the same label. One 20/30 fund might have you mostly in bonds, calm and protected. Another might still have you more than half in stocks, exposed to a drop right as you need the money. Same name, very different ride. A lot of that gap comes down to one design choice. To versus through. A to retirement path reaches its most conservative point exactly at the target year. A through retirement path keeps lowering stocks for years after, assuming you'll live off this money for decades and still need growth. Neither is wrong, but they're different bets, and the label alone won't tell you which you're holding. So don't trust the year by itself. To know what's inside, read the prospectus and check the glide path. Now the second thing hiding in the box, and this one is pure math, the fee. Every fund charges an annual fee called the expense ratio, quietly taken as a percentage of your balance every year. You never see a bill, it just comes out, which is exactly why it's easy to ignore, and ignoring it is expensive. Anchor on what normal looks like. The asset-weighted average target date fund fee was about 0.27% in 2025, 27 basis points, roughly $27 a year for every $10,000 invested. And it's falling. It was about 0.29% in 2024. That's the cheap, healthy end. But plenty of funds still charge 0.5%, 0.6, even 0.7, and up 2 to 3 times the average. 0.5% sounds tiny. Who cares about half of 1%? Compounding does. Take a $100,000 balance and grow it 30 years at a hypothetical 7% return. Compare two versions where the only difference is a 0.5% gap in the fee. That tiny difference compounds into roughly $165,000 less in the higher fee version. It's a simplified illustration, a lump sum, no new contributions, but the lesson is real. A fraction of a percent, repeated for decades, eats a 6-figure hole in your nest egg. And here's the encouraging part. You control this one. Index-based target date funds tend to charge dramatically less than actively managed versions. So before you buy, find the expense ratio and favor the cheaper, broadly indexed version. The low-cost option for the same strategy is usually right there. Let's pull it together. A target date fund hands you 3 things in one purchase. Instant diversification, one ticker holding thousands of stocks and bonds, automatic rebalancing. The fund keeps your mix on target so you never have to. And a glide path that de-risks you from mostly stocks toward mostly bonds as your retirement year approaches. That's why it's the default in most 401k plans. But remember the box. 2 things inside decide how this turns out. First, the fee. Favor low-cost, broadly indexed versions, because a 0.5% difference can compound into 6 figures over a career. Second, the glide path. 2 funds with the same year on the label can carry very different risk, so check whether it's to or through. This is education, not financial advice. But the principle is clean. Set and forget is one of the best ideas in investing. Just look inside the box once before you forget about it. If this finally made the fund in your 401k make sense, hit subscribe. That's the whole point of this channel. The money stuff nobody ever explained to you. And here's your perfect next step. We talked about the glide path, the stock and bond mix shifting over time. But what should that mix be in the first place? for your own goals and timeline. That's the bigger idea sitting underneath every target date fund. Watch the video on asset allocation next, and you'll understand the engine behind not just these funds, but your whole portfolio. See you there.